when archhawks turned mega doves in only one meeting. Last year, the Bank of England had been among the more cautious central banks, right up there with the ECB, not wanting to cut rates too quickly. But also, like the ECB, its plans are being changed for it by the circumstances in the economy. The global economy that forgot how to grow is forcing the Bank of England to change its feathers. The Bank of England is rapidly becoming the most dovish of any major central bank, as the forgot how to grow global economy is making the UK remember how to shrink. Britain is just another example, like Switzerland, of how optimistic assessments are based on economics that don't exist. They all believe, all of them, central bankers and economists everywhere, that 2021 and 2022 was a real recovery, and that 2023 into 2024 represented nothing more than a gentle slowdown to the disinflationary Goldilocks. But that slowdown was even bumpier in the UK than a lot of other places, especially late in 2023. But then the country appeared to come out of the slump last year, which at first seemed to validate the recovery idea. And that's why the Bank of England thought it could be cautious about cutting rates. In fact, officials refocused their concerns on inflation risks. The best example of that is Bank of England voting member Catherine Mann, who's described as an arch hawk, maybe the archest of every hawk in any central bank anywhere. She voted against each rate cut so far, that is, until today. Not only did Mann vote for the rate cut that the Bank of England did, she actually dissented again this time, but in urging the Monetary Policy Committee to cut by 50. You get that? The biggest hawk in the world went from not wanting any rate cuts to urging a 50 basis point cut in only a single meeting. Why? As I said, the world that forgot how to grow is reminding the British economy that last year was an illusion of stability. The real economics of the situation, small e economics of the situation, is quite simply, you cannot impoverish this much of the world and expect it to go just fine. A little bit of a slowdown, maybe tiny little short, shallow recession in 2023, and then clear sailing from there, 24, 25, and on into the Hollywood sunset forever. So what the Bank of England did in recognizing how it's going to be even bumpier, this transition from the artificial price illusion in 2021 and 2022, and that it's going to continue to extend beyond 23, 24, and into 25. So the Bank of England cut interest rates, their interest rates again, basically confirming what the markets have been pricing all along. And the monetary policy summary said from the BOE, GDP growth has been weaker than expected at the time of the November policy meeting, and indicators of business and consumer confidence have declined. That's putting it lightly. However, they say GDP growth is expected to pick up from the middle of this year, which is a backhanded admission that GDP growth is going to be not growth, and it has already been not growth for a long period of time, and that maybe, if everything goes in the right way, maybe GDP growth will pick up again in the middle part of this year, which would mean almost a full year without any before getting that far. And that's being overly optimistic that these rate cuts will actually have any positive impact on the British economy, which there's really no reason to think that, especially given recent data that shows things are falling off pretty quickly over there in the United Kingdom. Their monetary policy summary continued with, the labor market has continued to ease and is judged to be broadly in balance. And we have to say that's complete and utter nonsense. There were large payroll losses in November and December. In fact, there were losses in 4 of the last 5 months of the year and 5 of the last 7 months of 2024. And with those large losses in November and December, that shows that the economy and the labor market in particular has been struggling for some time. The jobless rate, the unemployment rate, rose to 4.4% in November, which is the latest data, which already matches April and May's highs from 2024. And it's going to rise again, especially given those payroll losses, when we get to December and into January. So to say that the labor market is broadly in balance is just wishful thinking at best. And that's, again, why the arch hawk of the entire central banking community is suddenly an ultra dove. Even the Bank of England's projections say the same thing. Their projections and forecasts for the unemployment rate in the UK, in November, they saw a 4.1% unemployment rate for 2025 this year. Now they say, well, with the unemployment rate already at 4.4%, this year it's going to be 4.5%. And again, that's being overly optimistic and counting on lower interest rates to support the economy and keep it from getting worse. And by 2027, the new forecast says the unemployment rate will continue to rise to 4.8%, when back in November, they're thinking it wouldn't get any higher than 4.3%. So circumstances are forcing their forecast to change, and it's forcing the Bank of England to behave more like the European Central Bank or the Bank of the Swiss National Bank and others around the world, the Bank of Canada, in more aggressively cutting rates in response to weakness they didn't think was going to show up. Again, the idea here was 2021 was a real recovery, sustainable recovery. There would be a slowdown from it because it was too hot, a slowdown that was engineered by central banks and the rate hikes. And then from 23, 24 into 25 and forever, everything would just work out grand after that small period of a slowdown. You hear the same idea in the UK, in Europe, in the United States, in Canada, in Mexico, and everywhere else. And it's not working out that way because the economy forgot how to grow. Just look at GDP in the UK. It basically illustrates everything that I'm saying here. It slowed down in 2022 like everywhere else around the world. And while the UK was able to dodge an outright recession late in 2022, it did fall into one at that global inflection in the second half of 2023. That's when we see unemployment rise in the United States and other places around the world. Canada, Germany, basically everywhere. The middle of 2023, we finally saw the labor market break. And in the UK, you had 2 straight quarters of negative GDP, which means at the very least there was a technical recession in the second half of 2023. But it was actually a real recession too because of the rising unemployment there as well. But that's what they thought. They thought that was the worst of it. Because not only was that consistent with their idea of how they thought the recovery was going to go, GDP then recovered by 0.7% quarter over quarter in the first quarter of 2024, which led to that mistaken interpretation. Everybody thought that meant the weakness was over. Same thing in Japan. Remember, Japan had a recession in 2023, and now they think that they're out of it and everything's moving in the right direction. You see the same global phenomena. Just a little bit of a slowdown in 23, maybe extending a tiny bit into 24, but then on their way to recovery after that. GDP slowed right away after the big first quarter, 0.7%. It slowed to 0.4% by the second quarter already, and then it was zero, flat in the third quarter. And by every account, including the Bank of England's, they made the same statement. It was very likely negative in the fourth quarter. So that would mean the second technical recession in as many years. But this second technical recession is far more profound because it says that the story that everyone has been telling of just a slowdown in 2023 and then recovery thereafter, something is wrong with that story. And the something wrong is this economy that forgot how to grow. They forgot how to grow in the UK too. It's almost like Germany, same pattern with some mild differences. In fact, GDP overall in the UK is up just 0.8% since the middle of 2022, very much like we see around the rest of the world. The economy never recovered, and then it has been unable to get there ever since, even though we're talking about coming up on 3 years of forgot how to grow. Against that backdrop, of course, interest rates are going to be going lower. Market rates about fundamentals, lower growth and inflation expectations. And while the Bank of England is still concerned about inflation, or what they call inflation, or even forecasting an increase in consumer price rates this year, that's not the major concern. The major concern is this downside, which continues. And so the markets are pricing lower and lower and lower interest rates because of lower and lower growth potential, which gets confirmed and confirmed and confirmed by each of these different places around the world and each of these data points that come in. Even as the Monetary Policy Committee at the Bank of England said, the statement said this: almost all respondents to the bank's latest market participants survey were expecting a 25 basis point reduction in the bank rate at this MPC meeting in line with market pricing. The median survey respondent expected 100 basis points of bank rate cuts this year, albeit with the overall distribution skewed toward fewer cuts, consistent with market implied path declining by around 85 basis points over the year. In addition, to international factors. There have been UK-specific considerations, including data news that had been taken by market participants to suggest risks of a weaker outlook for activity, which had been also partly reflected in a small depreciation in the sterling effective exchange rate. And that's a whole lot to say. Weakness in the economy, rates go down. And that weakness in the economy is becoming more and more undeniable as the end of 2024 gets into the start of 2025. Britain is just a complete and utter mess. And there's more trouble ahead. According to Bloomberg and S&P Global just today, UK house building tumbled at the fastest pace in a year in January, marking a slow start to the Labour government's ambition to fire up construction and unblock planning decisions. S&P Global's construction PMI plunged from 53.3 in December to 48.1 last month, the first time the wider sectors dropped below the 50 threshold, separating growth and falling output in 11 months. It was much worse than the rise to 53.5 predicted by economists. So in other words, despite lower interest rates, even now home building is falling off. I talked about retail sales in a recent video over the Christmas season that turned into an utter bust. I also already mentioned payrolls that are declining, unemployment rates rising again. No wonder the careful, cautious approach that the Bank of England was preferring has been scrapped in favor of we better start getting going here because the economy looks even worse. The recovery that we thought last year didn't actually stick. It was just a short-run fluctuation. Instead, we have to deal with the economy that forgot how to grow, and it forgot how to grow because you can't impoverish the entire world and expect it to just go fine. And the symptoms of that, the consequences of that forgot how to grow economy, that's what central bankers are reacting to, because that's what rate cuts are. They're a reaction to weakness in the economy, whether local or global, and usually the two things are synchronized. So central bankers are reacting to that weakness, and they're reacting to the fact that weakness is not going away the way they thought it was going to. So according to Bloomberg, commenting on Catherine Mann, she was the only member of the MPC who was expected to vote against cutting rates. Everybody thought she was the ultra hawk. She was going to vote against the rate cut today, and instead call for rates to stay at 4.75%. That person is Catherine Mann, an external appointee who has been consistently the most hawkish. Swati Dhingra, another external who is most dovish on the MPC, may vote for a half-point cut. And in reality, what happened was Dhingra did vote for the half-point cut. She did dissent and want the 50 basis point cut in this meeting, but Mann joined her. The most hawkish member of every central bank suddenly said, I want a 50 basis point rate cut too. Now, to be fair to Ms. Mann, she had said all along, while she was dissenting and voting against rate cuts to this point, she said at some point it will be appropriate to start thinking about lowering interest rates. And apparently, given how quickly things have deteriorated in the UK, she thinks that point is now. So the fact that the hawkish member of any central bank committee anywhere is now saying, yeah, let's cut by 50, that is in itself pretty significant. But not according to the Bank of England. The Governor Bailey, of course, he's downplayed the whole thing. You can't make too much out of Catherine Mann. We're going to proceed slowly because we're going to proceed slowly. As Bailey said, I would not overinterpret any other moves in voting patterns. It's important that the view on the future path of interest rates is based on the economic fundamentals. And Bloomberg added, the addition of the word careful to the bank's core guidance for future easing reflected questions about the global economy. They talk about tariffs, but it's really globally synchronized weakness that's getting weaker and weaker. Bailey continued, we live in an uncertain world, and the road ahead will have bumps, and the road backward had bumps, and the road ahead is going to continue to have the same bumps because it's the same thing over and over again. Every time they say and they forecast and they think that whatever local economy is going to get out of this mess, it's going to exit its slowdown and start recovering, it gets pulled back in all over again. It's because the background, the fundamentals, again, you can't impoverish the world and expect it to go just fine. And that forgot how to grow economy, that impoverishment, is going to continue. It's going to continue to pull all these economies back into the mess, never letting them do anything more than the UK had last year, or Europe, or a bunch of other places, a temporary island of stability that seems like a recovery starting, only to see it short circuit and fall off, another false dawn all over again. So we keep seeing this pattern repeat and repeat. And every time before it repeats, everybody says it's the end of the pattern, when we always have to go back to those fundamentals, the fundamentals that are priced in market interest rates, low growth and inflation potential. It's being acted out in monetary policy committees, which aren't really monetary policies, they're interest rate policy committees, and interest rate policies that are following interest rates in the marketplace, all of it together reacting to the forgot how to grow economy. And so we see it's not just the UK. That's really the point here. It's not just the British problem. We see it all over the world. And Germany's the best example. I keep bringing that one up because it's the clearest one. Well, the UK is really doing its best to rival Germany as the clearest example of forgot how to grow. But over in Germany, even the German central bank, like the Bank of England, is throwing in the towel on 2025 already. Here's what they said just a couple weeks ago in their assessment from January. After 2 years of shrinking output and next to no growth in recent quarters, the outlook for Europe's largest economy remains clouded. I love how they use that term, at least according to Bundesbank in its monthly report. At the same time, they say inflation is still elevated when it's actually not. In the first quarter of 2025, the German economy is unlikely to emerge from its long period of stagnation, the Bundesbank said, citing manufacturing weakness and uncertainty that's damping private spending. It's not uncertainty, it's not stagnation, it's not really forgot how to grow, it is quite simply impoverishment. That is the one thing that is behind everything. You cannot impoverish nearly the entire world and just expect that it will go fine from there. Just a little bit of a slowdown to come down from a red-hot economy. It was never red hot. That was entirely a price illusion. You can't take away a massive amount of purchasing power from consumers as workers, from businesses that aren't well connected, that didn't benefit from the supply shock and all of the government-funded programs that were meant to deal with it. You can't impoverish the entire economy and expect it to grow even better than it started with. And to be able to just smooth it over with some lower interest rates or government transfers or whatever else they call stimulus. Now, various parts of the global economy are doing this, evolving under these circumstances, these economics, small economics, and doing it at their own pace in their own way. But yet we see the same pattern everywhere. This sideways economy that they want to call stagnation is so much worse than stagnation. And it doesn't let you exit. It doesn't let you get out because you can't escape that one central fact, that the economics of the 2020s. You cannot make everyone poorer and then forecast the economy to get richer. Not in this universe. Whether everyone knows it or not, we're getting a lesson in economics. And that lesson in economics is being learned by just regular folks in the economy, by politicians who are losing their jobs, and to some extent, central bankers. Ultra hawks turning into mega doves. And with market interest rates in the short run going lower again, it's as if the market remembered the forgot how to grow economy. Went over all that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. Until next time, take care.